Hi everybody, Lou Desepoli here, Heritage Financial Advisory Group. We hope that the beginning of spring finds you well and enjoying the year so far. I wanted to take a few minutes, do our second quarter market update, explain to you what we see this year and what we think will happen for the coming year or for the rest of this year. A quick summary on the first quarter. January opened up, the markets were very, very strong. It was a great month. All different sectors of the economy were moving very well in the financial markets. And then along came February and March, and there was a tremendous amount of volatility. So what we saw was that the markets basically gave back the gains that they had earned during the month of January. So what happened? We saw that the markets were plagued by a lot of news about the speculation of rising interest rates, the discussions on trade fears with China, and also the technology sell-off, the big names that you know, Apples and Googles and Microsoft and Facebooks and companies like that. And that seems to happen once every couple of years. Technology has been the leader in the market for beginning of this year and last year, and it's not unusual for the leaders of the market to go through a short-term sell-off. As far as interest rates, we're not too concerned about it. The conversation is, will it be 3 increases, 4 increases, 5 increases? It really depends on what the economy is doing. If the economy needs to be cooled off by raising interest rates. So the speculation when we hear the Federal Reserve talking about how many times they'll raise rates, it really just remains to be seen on how the economy is doing. So we let the economic data tell the story, and at that point, the Federal Reserve will do what's necessary. But as far as interest rates go, we would expect maybe 3 more this year, if the Fed follows suit in what they say they'll do. But 4 seems to be excessive, but 3 could be the number, and even at that, we think things will be okay. Trade fears, China, tariffs going back and forth. As recently as last night, China came out with news saying that they were going to reduce the tariffs, allow U.S. autos to come in without being taxed in terms of their tariffs. And as of today, the market seems to like that. So right now, nothing is in place. There is a lot of discussion on it. We don't think this will be a problem. China needs the United States, and the United States wants to do business with China. So we think that this will all work out in the end, but a lot of the volatility you're seeing, 100-point swings upwards and downwards, it's just based on conversation. These are not in place yet. So we're not concerned about it until it actually happens, and as the trade and tariff fears subside, the market reacts in a very positive way. Technology will be back. These companies are, again, doing well. We are looking forward to the beginning of earnings season, which will begin very soon. And I think that when these companies come out with their earnings, as long as they're better than expected, these technology fears will subside. These companies will once again be doing well. And the technology for the United States and the world is such a big component of the driver of an economy, and these companies will do well and continue to do well, so we're not really concerned about that. Here's what we do expect. This will be a constant. We don't see it going away. We said it back in January that we saw a lot of it this year, and it will continue, is the volatility. The volatility has outpaced last year. Last year we had just a handful of days where the markets moved in 1% increments. This year I think we're over 30, and it's only early April. So that's a tremendous amount of volatility. But volatility is like grapes. It comes in clusters, and you'll have weeks of it, and then it can subside. So we don't want to get emotional about our investments. That's where you can get hurt. We let the fundamentals do the talking. But volatility is a theme. It's here to stay, and it's driven by sometimes economic news, sometimes political news, world events and crises. But we don't want it to affect our investment plan, so we don't want to get emotional about what we're doing. We just have to, withstand and absorb the volatility, and we'll be okay. In the end, we think that as I said, the whole trade situation will be resolved. It'll benefit both companies, but until it does, that will certainly add to the volatility. But what we see overall is the economy is doing well. The tax reform, while we're at the very beginning of it, will help this economy throughout the year. They're talking about perhaps a second wave of tax reform, maybe making some of these tax reductions more permanent. And if we can get on track with some type of infrastructure spending bill, that will be just a tremendous upside to the economy, and I think the financial markets as well. So there's a lot of good things that are going on, but let's not lose perspective that the fundamental drivers of what causes a market to do well are still in place, even with all this volatility. So we do see things going in the right direction. We're looking forward to the upcoming earnings season. So with that, we are on track. Overall, the portfolios are risk adjusted, are doing well. We're not, having big dips and declines with all the market movement. But if you do have any questions, please feel free to call us. We're happy to meet with you, talk to you on the phone if you want to have a quick conversation. You want to do a financial review, we'd love to have you come into the office. So please don't hesitate to call us. We hope to see you soon. And as always, if there's someone you know who you feel is not getting the advice or doesn't have an investment strategy, ask them to call us. Give them our number. We'd be happy to talk to them, and we would appreciate that. So we hope you stay well, and we'll talk to you soon. Thank you very much.